This is a reaction to what happened in 2020 where liquidity froze. So there was no buyer of last resort, right? There has to be a buyer of last resort when it comes to junk bonds, when liquidity and demand for this paper dries up completely and retail investors need their money back. You can't just lock the fund and deny them the money. That creates a very scenario where there's a loss of faith in the industry as a whole. So I think this step was taken to restore faith in investors' minds towards lower rated debt, right? Because there has always been a vibrant market for AAAs and GSEC, but when it comes to lower rated debt, there have been cycles where the liquidity has dried up. So I think this does give some amount of comfort to investors in the sense that there is a buyer of last resort, and in the future, if there's an event which creates so much redemption pressure, which subsequently leads to a liquidity crunch, then there is a buyer of last resort. So of course, it's positive for the industry. I don't think any knee-jerk portfolio moves need to be made in light of this. Let it play out. Like I said, there is really no reason to take an unnecessary credit risk for chasing that 2-3% for a 3-4 year period. We just don't see the logical sense in that. I would rather, like I said, earn 2% less a year for 3 years and sleep well at night. Because if it's debt funds, it is basically an FD alternative money that's going in. I would really like to not invest in any high credit risk funds despite this particular development. Although it is definitely good for the industry, I would like to see how this plays out in the scenario of any future credit event that may come up and how well it is tackled before I'd advise a retail investor with a limited understanding of credit risk to go in and even invest into such a high risk fund, just basis this particular development.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.